Welcome to the Independence by Design podcast, where we discuss what it means to be a business owner and ways to get unstuck from the day-to-day so we can design a business that gives us a life of independence. What's up, everybody, and welcome back to the show. Today's episode is going to challenge a lot of what you've been told about business value, valuations, and how to think about your financials as an owner. Over the last handful of episodes, I've gone deep into the merger and acquisition world, breaking down how valuations work, what buyers look for, deal structures, and how to separate the noise from what actually matters. But here's the deal. Most of that doesn't mean a damn thing if you're not generating any free cash flow. And you know that, I know that, and that's why I'm pumped to have Patrick Donohue back on the show. He and I have both been in the trenches for years, working with owner-operators who are trying to figure out how to make sense of their financials and actually use their business as a tool to build wealth and create options. In this episode, in our conversation, we're going to strip away all the jargon and get right to the fundamentals on how to manage it and maximize your free cash flow so you have real choices as an owner. And what I love about this is we talk about in our conversation why EBITDA is misleading. Yes, it's used in the valuation marketplace all the time, but why is it misleading for us as owner operators of privately held companies? And then how Wall Street style financial engineering distracts business owners and how you should be structuring and thinking about your financials to serve your long-term goals. And the whole point of today's conversation is to allow you to better understand the jargon that's being used so you can better understand when and how to spend time having conversations with, people about a transaction or people in the finance space. But, I mentioned something throughout the conversation where I needed to learn all this stuff so that I could forget it and then pay attention to the things that matter. And I'm hoping that that's helping you along the way with your journey so you can focus on the things that actually move the needle for you and your goals. Thanks for everybody for tuning in. Again, remember that the podcast is on Spotify as well as YouTube for the video. Please give the show a rating. It's what's helping me continue to build the audience, and then share it with a friend if you think someone else could be of interest of this conversation. Thanks, everybody. And without further ado, here's Patrick Donohue.
Well, how you define independence.
Oh, should we start like that?
Yeah. I want to throw it on from you.
And then this can be on the recording, and then we'll feed back up to. I think there's a really fun lift off of like what you were talking about with teaching and skiing and the fundamentals to what we're about to dive into with free cash flow. I really do. And I've spent 5 or 6 episodes, Patrick, in the freaking weeds on this stuff, and you're
man.
Okay, so how I define independence is having the freedom and flexibility over your time. And how we spend our time, in my mind, time is the only constraint we all have because we're all here and we all die. And then what we do with that time should be to create value. And then that value is rewarded in the form of money most often. and things that people value. And the more freedom we have over our time, the more we can do whatever we want, whatever that is.
Right.
And so money should help us fuel, and the value we're providing should help us fuel that. But to have the freedom to be able to do whatever I want with my time and think about whatever I want to think about is the most important thing for me. And I think the money is a result of the value that the marketplace tells me I'm creating or not creating. What do you think about that? What's your definition of independence?
I agree. I think of independence as the time component. That is the common denominator, definitely, is to really be able to utilize your time on how one sees appropriate.
So I think this will be an interesting lift off, and I'll put it. I can kind of put like a slight container on this of why I thought it was going to be fun to have you back on the show. And then the last 5 episodes that I have done aren't released yet, so I wouldn't have obviously expected you to listen to them. But you said something to me, and I know I've known this, Patrick, for a long time. I just have had one hell of a time articulating it with the level of conviction I now have. Of like you said, free cash flow is all that matters, and I agree. Ken Sangenario agrees that I just had on a couple of times. Every business owner operator that you and I've worked with also agrees. But there's all this jargon and shit people use to confuse the hell out of this entire topic of we either have free cash flow or we don't, right? It's like gravity. And what was fascinating with the last podcast I got done with Ken Sangenario, who's built this, it's called the value opportunity profile, but it's like the theory of constraints with the 8 functions of an area of a company. And he ties it into the weighted average cost of capital inside of discounted cash flow based on the WACC to shareholders. So like that's what he in the 8 functional areas, like what do we work on so we can place our bets with our time and whatever free cash flow we have to get the rate of return we need to justify the value and the time we're spending. So like I have gotten like super nitty gritty into this, but like, you saw at the EO workshop, I talk about normalized EBITDA in my workshop because like, honestly, Patrick, I had over 2,000 people. I mean, that alone is a first level of like awareness. That's like, holy shit, it's not just revenue, net income or K1. And then so like to get to this free cash flow is something that is intrinsic that everybody I think knows because they're juggling working capital, taxes, debt, and they either have money left over or don't. And you like tell me where now that I'm here again with you, like your level of conviction, this is the fundamentals. Like you said, with what did you call the two parts of skiing versus maybe we start with the skiing again and then how you got into the finance belief and conviction that you have.
Yeah, there was a lot there. What do you
I
want?
know, and I'm trying to give you
Well,
the,
but
and
at
I
the
don't
end,
mean to.
what do you want me to give you thoughts on?
Well, and I probably and I don't mean to overwhelm. It's just like what I wanted to do because it's been probably like a handful of months since we caught up, and you saw my workshop, and I wanted you to know like this has been the journey that I've been hammering home, and the three statement model is the only way to see the free cash flow. And you've been saying since I met you years ago, free cash flow is all that matters. So I wanted to give you that whole blanket statement to say like I'm totally on the same page, and there's a lot to unpack of your conviction behind that, but all this noise goes on in the entrepreneurial world from accounting metrics to all that other shit, which is kind of like what you said in the kids like when we were talking about the skiing. It's like my kids are getting taught how to snowplow and you're like, I don't do that. And it's like the level of conviction you have with that is the same one as like free cash flow is all that matters, right?
Well, so I had some thoughts to share, Ryan. I don't know if this is exactly what you're asking for, but I'll put it out there.
I
So
wanted I wanted to talk to you for an hour or so, Patrick. That's what I want
yeah,
to do, man.
well, so the I've gone full circle on all this type of stuff over 25, 30 years. And because early on in my career, I thought it was really cool that I knew and understood the jargon and what EBITDA was and how to calculate free cash flow. And there's a couple free cash flows to the firm to equity, blah, blah, blah. But
Yeah, right.
as I go in and work with entrepreneurs, like nobody cares and nobody should care. And a matter of fact, it's detrimental for them to get caught up in EBITDA, normalized EBITDA, free cash flow, and all that type of stuff. And that's why in the book, what I talk about, it's all about cash. And I simplified it all down to like a cash management trifecta. How much cash do you have today? How much do others owe you? And how much do you owe to others? And that's the net effect of where you're at. And a lot of entrepreneurs do think in that way because that's what matters at the end of the day. The problem I have with a lot of the terminology and why I've intentionally gotten away from using any terminology like that, like I abhor the term EBITDA. It shouldn't exist. I was there when it was made up. It's not a term that should even exist. But here we are. Everybody uses it, and then even worse is everybody thinks they know what it means, and even practitioners don't, which is a whole nother subject. But the problem I
I'm
have,
smiling. I'm smiling because I'm just in vehement agreement with
yeah,
you.
and the problem I have with all this, because you nailed it right out of the park in the beginning, Ryan, is that the jargon confuses, and the problem I have with that is that Wall Street and service providers and everybody benefits and makes a lot of money by making and keeping entrepreneurs confused. And that's what I really hate about the whole thing. Because all this stuff is actually super, super simple. Valuation is actually super easy, it's super simple. But everybody makes a hell of a lot of money making it confusing.
Oh, Patrick, it's amen, brother. And
I've been a little, I'm going to be blunt with you, Ryan. I've always
yeah,
been
no, I'll do it.
worried about like being that forthright with you because you also like
No,
you
no, 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 no. Well,
normalize the
Patrick,
way you talk about some of these things and so on and so forth. But that's where I help people through all of
no,
this type of stuff. But I want to just like hit the
I fucking
straight
love
on.
it, dude.
I
No,
want
no,
to
no.
talk
I
about
love it. No,
valuation, and there's all these guests that you have that like to make valuation complicated, and they run valuation businesses and blah 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 blah. But at the end of the day, it's a lot of noise.
oh, there's so much meat on this bone. No, don't hold back. I totally
Sorry.
agree with you. No, no, no. And so, like, And Patrick, full disclosure, man, I've been on. So I'll give you what I've been like the journey I've been on even the last like 6 to 12 months. Patrick is like because the ownership framework that I've worked on, which is the foundation, which you saw at the EO workshop, the Vistage workshop, it's like this red pill experience of like, hey, here's a lot of the shit everybody talks about, right? But at the end of the day, like, I mean, I like part you heard you've and everybody on the show like has heard my story. Like when we had no money, not our family business, it was like, where are the effing receivables? How much inventory do we have? And then who do we owe? And can we extend it? And then do what's our line of
Because
credit?
at the end of the day, all you cared about is how much cash we have in the bank account.
I don't have enough money for payroll.
Yeah,
Exactly. And
yeah,
which is why now, Patrick, I won't even do my workshop for anybody that does not own their company, the majority share or
yeah.
manage cash flow, because like, it's like, oh, I was in this workshop. I'm like, holy shit, out of the 19 people in here, 2 people owned payroll. Like owned where like, if it goes bad, their ship sinks. So let me go back to like, it's so funny, man. I love how you started this because how I got here when you said you've gone full circle, Patrick. Me too, man. And here's why. Because like, but you started with jargon and came back to like. There's also this dummy curve in like Sandler sales where it's like you know everything. You ask why a bunch of times, and you get really technical. Then you just ask why a bunch of times again. So Patrick, honestly, and I think this is where hopefully some of my material resonates with people is like I thought I was dumb. Like I was running a $20 million business. Everybody would confuse the shit out of me, and I assumed everybody knew what the fuck they were doing. And then I'm like, oh, you have suits and you have acronyms behind your name, and like, we must be the dumb people because my dad went to third grade twice. I got a D in accounting, and it's just like, well, you must know what you're doing. And so after I like spent even more time over the last 6 months, Patrick, it was me with people I respect that believe what we're talking about that are finance operator or finance like Ken Sengenar you would like a lot. I mean, he
Yeah,
understands how
I listened to that podcast twice. I just re-listened to it.
yeah,
That
he's fantastic. I mean, because like he understood finance, but he was an operations guy. But I say this because I was with GPT, so I upload all the transcriptions into GPT, and then I'm like, okay, how am I thinking about this? So like I was like, okay, return on net assets, return on equity, and it's like all accounting bullshit. And then literally GPT after like a 5 month string of sessions, Patrick was like, Ryan, you are correct. All of that other shit is jargon, and the only thing that matters is yeah, so I screenshotted this one.
even the all-knowing God understands. Yeah. Yep.
uh, it's so when I think about like when I got it when I was thinking about this call and this conversation, like you have I've got a couple clients that you and I both also know, and like your fund and what you and Nick are doing and matching I mean the last episodes we'll put links to it of like the matching the capital gap or like capital matching of
Yeah.
goals and return and walk. I think it would be really cool to like talk about like your desire with this context now instead of just staying at the top level, like how your mechanisms of what you're doing at Hill Capital of like matching the cash flow gap with people. Like where did that inception and kind of bring us maybe back to like with this mindset, how the mission that you and Nick are on?
Well, in terms of our structure and how we think about these, it's extremely simple. Is that we need to return an amount of money, a return to our investors, to compensate them for taking the risk and doing something other than buying an S&P index fund. And so then it needs to go into a business model, an economic engine within a business. And that business has to have a reasonable chance, a good chance that it can generate economics well above what that cost of our money is. It's really that simple. So if we put in $1 and I need to get $2 to $3 back to justify the risk and give a return to our investors, well, that dollar within the company needs to turn in probably to at least $5, and ideally 10 or 20 or whatever the case may be. So we could talk about forecasting by month, P&L balance sheet cash flow statement for 5 years. But at the end of the day, it's really that simple. A dollar of external capital goes into a business and it needs to be able to, create value well above and beyond that cost of that $1. That's it. That's all we
Yeah, and the way that the useful things about the jargon that I think has been helpful for me as at working with my clients, Patrick, as well as just potentially some of the listeners, is like that opportunity cost that you just talked about from your investors and for you also applies to the people that own the company. So
Oh,
like,
very.
but what happens, I think they don't, a lot of times we don't default to thinking that way, which is like, okay, like, because the weighted average cost of capital, which is the freaking hurdle rate, right? Like the hurdle rate, meaning the opportunity cost, meaning like you could do something else. So like, if you're not going to do something else, you should have like either it's the owner operator's goal that becomes the hurdle rate in their cost, or it's they raise the money or whatever it is. But like thinking about it in terms of cash flow and equity growth, I think is very helpful for them to determine like, should I go put it in real estate or S&P 500, like you said? And then I think it is helpful for people to think like, well, how do I de-risk it and create that return instead of just making shit up? What do you, when you've been doing this, because like you and I and Nick, we've done events and stuff like that together, like, what's your thought process on like the advisor and owner operator community and like the level of understanding of this? Because like, I mean, we've both been on a similar thing. You've got the book, and it's like, what's working for you to get through to people?
A whole lot.
What's that?
Not a whole lot. Not in all seriousness. I mean, that's why I love your work. I love podcasts. I love articles, all that type of stuff, because whether it's this topic or any topic, entrepreneurs are extremely busy. Their most valuable asset is their time. They don't have a lot of time to like dive in deep like some of this stuff can require. So if they can pick up nuggets here and there through Vistage and EO or YPO or in communities that they're part of, I think that's our best bet. And I think that's where the needle has ultimately gotten moved, where I've been at an event and like this, just kind of chatting with somebody and people pick up a few nuggets and like, oh, I want to dig into that deeper. And then they're motivated to see you at the upcoming EO event and to dive in a little deeper. But but
It's hard,
it
isn't it?
is
It's just
it
like,
is tough.
well, and like, and I think about, it, you and I share a huge passion to help the people who are the value creators. I mean, like that's why when you and I first met, I was like, you're my type of people, right? Like we both care about providing value because either you're providing value or not. And like when you like, maybe we can talk through like, because I think when you talk about the jargon and everybody that benefits the confusion, it bothers the living shit out of me. And same thing with you. Like you and I are like, it's such a destructive situation, and like and it's maybe talk about some of the pitfalls or things that should people like we're if you were to be what do you have a visceral reaction to in the marketplace, whether it's commercial banking or like other pitches or like you can buy a company for 10 times 1 million EBITDA. Like what are the things that where you're just like, god damn it, that's ridiculous?
Well, I have one visceral reaction right now, but what I will say, Ryan, is I don't think about it necessarily being like giving them a straight shot to the perfect answer. I think about more about like providing nuggets and making sure the bumpers and the guardrails are up so they don't get taken out. Because everybody's going to go shoot some bullets and some are going to hit the target or some are not. And that's part of business. They should. They got to try some marketing. They got to try this. They got to get burned once in a while and various things they do. But I just want to make sure we avoid lights out risk. And so that's how
Oh, I
um,
like that. I like
I've
that.
I've come to think about it. So, are there various aspects within banking and Wall Street and this, that, and the other thing that could be better? Heck, yes, I do. It could be optimized and so forth. But the only thing I have a very visceral reaction about today is around these really cute fintechs that are merchant cash advances, and it's a new skin to an old game, which is providing sharky payday loan types of structures. And it's really bad right now because back in the day, somebody could get 10, 20 grand with a few clicks, but now it's money that's like lights out money because in a few clicks, we've seen companies take down 250,000 and more with a few clicks and they don't even know what they signed. And that's past the point that the vast majority of the marketplace can help them. Their bank isn't going to come in and refinance that or help them out. And it's really bad right now, Ryan. I know a few companies that have gone under because of these things. And it's so that's the only thing I have a really visceral reaction to is that some of these.
I think it's worth double clicking and zooming in on this, Patrick, because And when you say merchant financing, I mean, that could be like people were like, it's like, so I know people in the Amazon FBA space. It's like Amazon, I mean, literally like the buy now, but it's like, here's 750 grand. It's like, holy shit, I got
Well,
750K and poof, it's
I
going.
mean, ironically, I mean, that is not ideal, but that's one of the best players. So some of them that are integrated into the platforms, but some of these standalone fintech, some of the names have been around a long time, but some of them are new. Some of those are really, really bad the way they structure them, in that the real cost of capital is anywhere from 40 to 120% is what we've seen.
And it's supposed to be illegal, but there's like, isn't there like legal ways of them getting around the
Still
ability to do?
still mystified on how they do it, but I think it's because they call it other things, and and then at the end of the day, the stated interest rate might be 15%, but it's all the fees and everything else that they layer on is what
Mhm.
really drives up the cost of capital.
Well, and I think this is worth, honestly, man, like, I think that this is worth talking about because when what I think stems from this topic is why is this a thing? What's happening that's leading to people doing this, what to look out for, because like, so here maybe I'll kind of kick it off because I want to hear your thoughts, because you and I've had a couple conversations around this, and it's near and dear to my heart, Patrick, because we were factoring. My dad and I were financing our receivables, which is why we were in the shitstorm, and the banking community was so puckered up from the financial crisis that all we honestly needed, Patrick, was a $1.5 million SBA loan, or a revolving line of credit, and a $1.5 million refinance SBA loan. And we would have, like, I'd still have the company, honestly, but no one would give us the money. Yet here we are, and there's everybody dishing out crack cocaine merchant funding left and right. And I'm like, it couldn't be anywhere different
Do you know? Do you
than
know? Do you recall how much of that factoring was costing?
um I, every once in a while I'll call up my dad and be like, it was $5.6 million in hard fees that we paid them over the course of 10 years. And then that has nothing to do with like all the other bullshit. I mean, and Patrick, this is all subjective for my own experience, but I want to say that out of 100 employees, 30% of people's time was spent juggling cash from payables, receivables, inventory, supply chain issues. So like, I mean,
It's a vicious cycle, and in companies that have our intensive working capital have that, where they have the payables, and or excuse me, they on their side they'd have the receivables and all that type of stuff that they have to deal with. It's
well,
really
and
difficult.
Well, maybe, I mean, I don't know if you and I have ever dove into this. I'd be happy to share some of the numbers and what we had going on, because I think like this could maybe help some people think about like, okay, where does Hill Capital fit in? What's the difference between Hill Capital and the merchants and a commercial bank, with a line of credit? I think there's a lot of potential value here. Like, so Patrick, I mean, it's been 10 years, so forgive me if anybody, like, if my dad's listening and I got a couple of numbers wrong, but like it was like 1.3 million in $1 to $1.5 million in receivables,
Yeah,
$1 to $1.5 million in payables, and then about the same in inventory. So like, I mean, like because we were a distributor, right? We go buy shit every single
yeah,
month. We have
yeah.
all this inventory that we're servicing copiers
You
with.
were operating a bank and you didn't even know it.
Yeah, yeah. Trust me. Now doesn't it make so much sense why I care so much about finance? Because I was like, everybody had the gun to our head. Yet I'm paraphrasing. Everybody was like, "Wake up, Ryan, go to work." And it's just like, this. Wait a second. We have all the risk, and you were right. We were a bank, and we didn't even know it. And the Northeast had a factoring product that they sold us, but they were making 750 grand a year in fees off us, Patrick, and they couldn't have. They wanted to get rid of the factoring because the FDIC was making them, but then they couldn't get rid of us because they needed the fees. So it was literally like my whole, like, it was a race to who could get healthy enough. And so the challenge was, Patrick, I mean, like, I was turning around when we were turning around that business, it was like we had no lines of credit. It was like the moment we stopped selling is the moment the whole thing imploded. And so, like, when you say it's a vicious cycle, and what is so interesting to me is the capital stack of different ways to get this. What what we were going through and the lack of flexibility. I mean, effectively it was merchant funding. I mean, like, it was like there was no way for us to get out of that unless, because like when we every month we were arguing over a bridge loan of 300 grand for payroll
Yeah, no,
because of
that's
the cash conversion cycle. So I mean, maybe like within that context, like I think that this is what people get into problems with. they get a little bit behind, and then you just want to like, you're like, hey, I can see the visibility. Like, there's a couple clients are going to close, and we're like, here's the opportunity, and like, next thing you know, your hope becomes your biggest nightmare because you didn't reconcile with reality and deal with some hard things. So I don't know, man, like where you want to go from there. But like, I think what you guys are doing, I think has always been interesting because of the how you fit into the marketplace.
Yeah. I'm guessing it would be interesting if you had an idea around like what the annualized, cost of capital, the percentage
I
API.
feel like it was like 23 to
So
28% is what.
that would have been my guess because actually that receivable financing, like that stuff looks great and it's a walk in the park and it's a wonderful product compared to the stuff that's out there today.
Well, I know. And maybe we can talk about like maybe it'd be helpful. So like the way that we did it with the receivable financing, and it might have been other like, and it's been 10 years, Patrick, and like I've learned a lot since then. But like I know that what we had to do is every single purchase order we got, we took a picture of it, we sent to the bank, we got 90% in the cash. It's just like never stop selling because that's how we did it. And like we got really healthy, but we couldn't ever get ahead of that ever again. And I don't want to know what the stated interest rate of that was, but all of the operational inefficiencies from juggling that to like the lack of ability to reinvest for growth. I mean, there's a
Yeah,
lot of stuff.
it's a great point because that's what we're seeing too with companies that are taking these things down. It becomes the tail that wags the dog. And even if it's a smaller dollar amount to the overall cap table or whatever, because they're pulling money, sometimes daily, oftentimes weekly, sometimes monthly, but it becomes the tail that wags the dog. And all of a sudden they're scrambling to do all these other things because now they're contractually obligated and personally guaranteed and you know, everything's tied and they're getting the money pulled directly out of their accounts and so forth.
So let's talk, maybe give the listeners a little bit of a snapshot. Merchant funding, like what are the kind of the attributes of it, and like how easy? What are the dollar amounts, and what like you because you were saying coming out maybe daily, weekly, but like what are some of the attributes of it?
Yeah, I've been studying this a lot and I can't even probably give somebody all the attributes because the industry uses a lot of jargon to call it different things and so on and so forth. But just know that anything that's got a website that is quick and easy to upload things and talks about, taking a percentage of receivables or pulling money directly out of one's merchant account. So a lot of times, if they're selling online, those are the merchants, and so they can pull
Like
directly.
Shopify, PayPal, QuickBooks.
Exactly, they can pull out of that. And so what we're seeing is that it doesn't matter what the title is because they could call it all sorts of things. It's super important to actually read those documents, have it reviewed by legal counsel, and actually know what the heck one is signing before they do, because that's the problem is people are literally click, click, and done, and they've never even read the docs. And it's amazing how many hooks and things people are signing off with without having to read it because they make it like, you go to a website and the terms and conditions on buying a little, signing up for a little piece of software, they're treating it like that, scroll through quick, click on it and done. And they don't realize what they've done to themselves. And the problem
And
is we've seen deals where they literally charge all the interest all up front, so even if they want to get out of it, they can't. So if they got out of it day one, the cost of that money would cost like 150% or something like that because they didn't pay it down over the course of 2 years or whatever the case may be. The stuff that's going
it's
on is
wild.
just it's it's unbelievable. It's really concerning. And it's too
um
bad because I think some of these products they definitely have a place in the marketplace. There is times I think about like a catering business. Somebody gets a big order, to cater a wedding, and they need 10 grand because they got to buy the food and kind of fulfill it, and they know they're going to get paid 20. Sure, pull down 10 grand and pay them back 12 grand. So very expensive money, but over 30, 60 days, it's like whatever kind of a cost of doing business. But and that's why what we do is very different. The problem is people are taking down that type of money and are using it for payroll and things that are like long-term costs. They're not actually using it for something that they're truly going to get cash for and to truly pay it off. So it's kind of like the same cycle that somebody takes a credit card and just builds that balance and and it starts building upon itself. It's the same problem.
And I think you hit on something that's pretty important. And I think I learned this the hard way, where like when the capital doesn't match the investment, which we won't have to go into the commercial banking world about how messed up all the capital matching is of, long term versus short term risks. But like what you just said about the catering business, I think is super important because I've also seen that in commercial construction or something like that. Matt Patrick is like, hey, I'm going to get this money in like 30 days. It's going to be 25% cost, but like I can see the return. I mean, that's really what it is. You can see the return and it's short. It matches the whole situation where like when we had it, it was like our situation was like, it was about the operations that was important because I could see the cash flow into the future, but it was like I couldn't get out of the suffocation of that short term vicious loop. And like when I think about, I mean, God, you said 10 grand with these, like you said, it could be upwards of $1 million, and then it's like next thing you know, you're investing it in long term stuff, but the cash isn't coming right back in.
Yeah, I mean, if something becomes a problem at 10 or 20 grand, most people have some friends or something, or could go to the bank and truly like take care of the problem. But when it gets in the hundreds of thousands of dollars, that gets beyond the capacity of the vast majority of entrepreneurs to be able to solve for that. The other problem is like with the capital matching, next to nobody in the ecosystem has any incentive to actually help companies think through capital matching. That's what we do at Hill Capital. So
Mm-hmm,
we are
mm-hmm.
forecasting our own proprietary model, our financial model that we put together with the forecast to actually look at what is the economic engine of this business and what can it look like. And we're doing all that legwork to understand cash in and cash out. Next to nobody does that. Venture capital doesn't because they're just betting on it becoming a big thing, either go big or go home. Receivable financing, factoring, all that type of stuff. They're just grabbing collateral and assets, and that's how they're justifying their loans. Some bankers will look at a forecast, but they're not actually really doing any, calculations, in my experience, to help them kind of think through that. And then they just have basically a term loan product where it's kind of straight line, where it's principal and interest. And so nobody's actually really thinking through like, okay, you're borrowing money or you're getting money because you need to fund some type of cash expense.
Project.
That's
Yeah.
why you're doing that. It's like, okay, how do we do this so it makes sense? So you've got enough cash to get through this, plus some wiggle room. And now what can it look like to pay things back? And that's where that always will fall on the entrepreneur, on the business owner. It needs to. But absent that, again, there's next to no one in the marketplace that will take the time and has any incentive to help think through that.
You just hit on my mission. I mean, like honestly, you go back to it's a more nuanced version of independence, but like why I've done this, Patrick, for 10 years. It's like I had like that whole economic incentive machine that had no vested interest in my dad and I's outcome suffocated us. And like the only way I could find independence is I'm going to learn how all this shit works so no one can tell me what to do. Fuck off, everyone. I mean, like I'm saying that in a very like, it's well, because like the way I think about it, and it doesn't mean that everybody's bad. And I've had my own personal journey with this, Patrick, of like I got really, I think 10 years ago I was pretty resentful, and now it's like okay, it's like this weird like reconciliation that I've had, and I pick on the healthcare system a lot, Patrick, and you've done some. I mean, I've watched you, man. Whatever your habits are, but like you've done some really cool like changes and evolutions over the last couple of years with your health, and it's like the moment that I realized, like, hey, guess what? I'm an insurance code for the doctor. Every doctor wants to find the insurance code that best fits them to submit it to the insurance company, and it's not a free market. They're going to get guaranteed to get paid. And then, by the way, every food product is based on big food, who is incentivized to sell that shit to us in every single store. And like Peter Attia, are you familiar with him at all?
Oh, definitely. Yeah. One of my favorite.
Yeah, his book back's there. And I'm like, it's a 500-page book that scientifically tells you you need to sleep 8 hours, wake up, do some exercise, stretch, lift something, and eat well. And like back to like when you started the podcast, it's like free cash flow, man.
Exactly.
Like
Free cash flow.
it's it. And like and so, but like the moment like if you think about it, we've all had to become doctors because like all these doctors and all these food companies and
Exactly.
all these different things, like
Yeah.
guess who's responsible for the outcome?
Yep.
I can't sleep well. I can't go to the bathroom well. I have bad anxiety. Well, why is that? Well, no one else gives a shit, Ryan. You have to figure that out, and then you have to manage all of the. It's like fighting gravity. I don't know. How do you feel about that analogy?
Oh, it's spot on. I love it. Exactly. Healthcare. It's absolutely spot on. You know,
So when you think
the best answers are actually the easiest, but nobody in the system is incentivized to give somebody the easy answer and the most straightforward answer.
they're actually incentivized to sell them the easy answer, which like I think is
Well,
super.
they're incentivized to sell them something that might feel like an easy answer. They might
Oh, fair
they
enough.
might get there in
Fair.
a roundabout way, but I don't think, because if it's an easy answer, there's nothing to sell. Right? Like that's the ironic part. Like
It's
you
so
could give you
true.
a
Yeah.
pamphlet or just tell you something like you just did. You covered everything you need to know about your health in 5 seconds, and you can't sell that, right? Nobody's going to
Yeah.
pay Ryan for that advice.
I know. I know. It's so true though. But it's so funny because like even not only because there's nothing to sell, but it's unbelievably hard to just do the basics though because the entire machine is plugging along against that. And what I think is that like it's the same. I think the healthcare analogy works so well, Patrick, because like a doctor comes and goes blah 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 blah, blah and you're like,
Am I going to live or
what?
die? How about that, doc?
Yeah.
Yeah.
I don't feel very good. So
Yeah.
like, do you think that that has something to do with it? But like, when you and I going back to we've both gone full circle. It's like I had to learn all the jargon to go. You're bullshitting me.
Well, so that's what I talk about in my book, and I do outline some of the terms. So I mentioned like EBITDA once, but like I mentioned some of the terms because we do need to empower people to be like familiar with this. But that's where I share with people. I'm like, okay, when you hear these types of things, you should start to have a filter that goes up
Mm-hmm.
and put up a litmus test, because if somebody is going to start to get cute with a lot of terms, it's probably because they're hiding something or trying to do something different or whatever the case may be. And that's why I help educate and encourage entrepreneurs to like ask the really simple questions. So like if somebody is going to provide them a service, just the simple question of like, how do you make money? Well, we do this and that. How do you make money? What is the fee you're going to charge?
Yeah.
And I'm like,
Right.
tell me about this fee, that fee, and we'll do this or whatever. Like, tell me just the baseline of like what does it cost and how I need to think about. And that's the same thing with money, and that's why this whole fintech thing has really got me quite upset in a lot of ways, because they're really doing nothing new other than they've gotten overly cute on all the fees and use of words that basically hide what they're doing. And at the end of the day, all what they're doing is charging, 45 to 150% for their money. That's it. Like you can call it withdrawal fee, you can call it an early termination fee, call it whatever you want. But at the end of the day, it computes to a cost of capital, which is an annualized interest rate.
Right. And Patrick, I mean, I've been watching this because of how much I care. Well, how passionate I become about this. I mean, like, shit, it was like back in 2020. Like, I mean, Affirm, Synchronicity, or whatever, like all these different tools, but like, there makes no logical sense why a bunch of investors would give someone a pool of money so that pool of money can give people a 0% interest loan. like zero like logical sense at all. So they're making their money by assuming people are going to screw this all up. So you're just betting on everybody's pain, effectively.
That's what's got me really troubled, is that the incentives are not aligned with the business owner entrepreneur. One would think that the incentives are aligned to help the business grow and to get better. These companies actually make more money when they get into trouble and default. That's what's really troubling about this. I mean, it's already hard enough to be an entrepreneur, in the small, medium-sized marketplace is already hard enough, and they're at a massive disadvantage to big players already. And then to have, this type of stuff happening is just, it's quite disgusting.
It is. And I think that these type of conversations that we're having right now, Patrick, are really important. And it's kind of like, and and here's why I get into the jargon too, and why I think these conversations are this important. It's kind of like I watched Andrew Huberman and Peter Attia in the last 4 years explode in popularity, and people are like, "Well, Huberman, you're never going to get popular. He's got 7.5 million followers because he goes on for 2.5 hours and talks about like the molecular level of what happens to booze." And then people are like, "No one will ever want that." And then what I think about health and why that's I think correlates to what you and I are doing, Patrick, is at some point you feel so terrible that you're like, I have to own this shit. And then like it's like, well, how do I own it? Well, I have to learn exactly how dopamine works, exactly how the mitochondria works, and exactly how booze works because no one else cares about me. And so like I think that like when we say like these conversations, I think it's important for us to have like the mechanical conversations of the jargon, the bullshit, what really matters, because it's the source of truth. And like what I see in like when you say like the economic incentives, I mean like the whole machine is incentivized to extract from the value creator of the entrepreneur.
Very much so. Exactly.
And
Spot on.
have you read the book Makers and Takers by chance?
No.
There's it's a sign of a it's back there. It's a sign of a dollar sign, and there's the makers, and then the takers are taking it out of the makers. But why I'm saying this is because ITR economics and like all these, I mean, you name the various sources, Dalio to Peter Zayon to like the demographic cliff is happening. We have so many people retiring, and they're going to move from an income producer for the U.S. That'd be like I've joked around it with people. I'm like that'd be like me taking my 22 salespeople and putting them in accounts payable. Like they go from revenue generators to an overhead, and so we have like 30 million people, and we don't have enough replacement rates, and so you have like this weird like we're gonna have less like the revenue. So like where's like there's the like I think there's gonna be less cash in the system, which means that if people don't have a plan, they're going to have to figure out how to actually have a plan for that future cash flow. And I think really good things can happen for the people that have a plan because there's going to be demand out there and all that stuff. But I think it's, I look over the last 5 years, it's like, hey, ERTC and PPP, and it's like I call it the bridge to nowhere. If they didn't have a bridge to the next future cash flow, it was like just a short-term Band-Aid. So any thoughts about like, because I think what we're talking about right now could help people navigate some of the complexities of it. I think it might just be harder going forward to juggle cash flow and what's going on.
I agree with you. Again, going back to your healthcare analogy, that um, it is available and it's very beneficial for people to get into the details. It's one thing for us to talk high level about free cash flow, but if one wanted to really understand the nuances, it's never going to hurt them. But I also want to be cognizant that, only 1 or 2% of the population is going to dive into the details of the financials and the accounting. And same thing on healthcare, right? Like you're in the 1% club. You're one of the few that actually will get into what is mitochondria and why would it matter and how do I think about this. And for others, they're going to take little bite sizes and maybe, talk with you at the gym a little bit and pick up a nugget and go do their own thing, but they're not going to spend hundreds of hours on it. And that it would really take, or if you believe in the theory of expertise, 10,000 hours or whatever it would take. That's just not realistic. And so I do think that it is in the best interest of entrepreneurs to be thinking about this, but I also.
Why do you think Huberman and Attia have gotten so popular though?
I think people do pick up little nuggets here and there, but I don't think as many of those people are actually diving in deep. I think they're able to pick up good numbers because people will, listen to a little nugget here and there, but I don't think as many of them are actually putting in hundreds of hours.
I agree with you. I agree with you on that. Yep.
But with entrepreneurs, there is a real incentive, always will be, should be, to really like learn and understand how economic engines work. And for those that understand that, there is and going to be massive opportunities, as you've alluded to.
I agree.
And there's always going to be changes in the ecosystem. There's going to be things happening in the economy and politics and so on and so forth. That's always there. The unknown is the constant. But those that get comfortable with the unknown, get comfortable with being uncomfortable, and that can focus on an economic engine, they will do very well.
Wow. Yeah.
And so I think that's why, the work that you and I and others do is very important because, we are points of entry for people to learn about these things, pick up nuggets when they can. And if somebody does want to go deep, there's no shortage of things they could go deep on.
Well, and agreed on everything you said. And I think a couple of things. I'll start with the when I hear economic engine, just again for verbiage for people, if we go, I don't know what that means. It's like it's the eight, when I think about it, it's the eight function areas that Ken Sangenaro talks about. It's the machine that produces the value that kicks out free cash flow at some point because you produced enough value after your cost of capital to generate free cash flow. And it's like understanding how that all works allows someone to look into the future and place more calculated bets to keep it going.
Yeah, I always call it an engine because there's an input and then there's outputs. If you think about a traditional engine, there's some type of fuel, typically gasoline. The output is the energy coming out, which turns the wheels. But also the one qualifier would have, and I think this is one of the challenges that you've seen with people talking about valuations and so forth. Free cash flow can be negative, and things can be valuable that have a negative cash flow and actually have negative cash flow for long periods of time, and that's been demonstrated. A large part, most people think about like in the tech industry.
Yeah, yeah,
And those
Amazon
are
or
all
something.
very valid business models, and that's where the problem with valuation practitioners is that if it doesn't generate some type of cash flow in the near term or something can get their hands around, their models fall apart. That's the problem with the traditional discounted cash flow model. And that's the problem with, there's a bunch of books on my shelf by, PhD academics that, write all about, cash flow, free cash flow, and what it is and so forth. But I do really want to highlight that value is and can be built by going through long, long periods of negative cash flow. And so I
But
think
the assumption is that it's going to generate cash flow in the future.
at some point, but that also for a lot of people, and so you see this like in medtech startups, biotechs all the time, that cash flow might be simply an event where they sell the business. So
Let's follow that chain of thought. But then someone bought the business because they wanted.
they can take it to the next level, and
But
ultimately it
that's
will generate.
right. But the constant is someone has to make some money somewhere somehow in the system.
Correct. Yeah, very much so.
I
But,
think,
but
go ahead. No, keep
yeah,
going.
but for like a medical device company that it's going to take 12 years to go through FDA and it's all
Mm-hmm.
R&D and they got to spend, $200 million to develop the next, implant in the body, that's going to be all negative cash flow. And that event may be selling to one of the large med device companies that can see it to fruition and then bring it to market and commercialize it to the tune of billions of dollars. So all what's happening is it's all a discount to that view of what that cash flow event or series of events, if it is generating annual cash flow, a view on what that is. And
Totally.
that
And
is,
and it's so funny. No disagreement at all. And I think when you and I are trying to bring perspective and open the aperture and the view for people, it's like, okay, like when there's that infamous video of Bezos, I don't know, was he on Leno or Letterman when he was like, I don't make any money. And this is like back in, it was like, I don't know if it was the late 90s or early 2000s. And like Leno was like, what? And like now, like when I think about VC as a percentage of all of the companies, like absolutely plays a fit, right? And like I was talking to my wife because like I got people that I know dearly that work for VC, and I'm like, there is zero effing chance that companies ever make any money, and like not only for themselves, but even if they sell, like I mean, like I don't see, I even with all of the AI things that could happen, I couldn't see how that this thing could make the money that it would need to yield a $4 billion valuation. Like,
but they only need one to believe that, right? Because the value is in the eye of the beholder, and that's what makes this
but
thing kind of like fun.
I agree with you, and like, and I won't say that I can't be wrong on this, but here's kind of like what because I know we're up here in the big meta conversation, but I think we can bring it back down to like a lot of the people that you and I work with, which is like there's a place for that, right? Like, but there has to be one buyer that views that product or IP valuable to pay that, and then that's fine. And as I was having this conversation with my wife, Patrick, it couldn't have been any more perfect. I wish I had it on video. I was like, because I was explaining this. I'm like, Megan, I'm like, it's totally fine because this exists. Like VCs exist. It's 20 years. It's Amazon. I showed her that video, and she goes, and she's not totally in the the business jargon. She goes, well, that would be like a unicorn. It's like because we got daughters and like meaning very effing rare. And I'm like, fine, exactly, but like the people that you and I end up working with that are listening to this, I mean, boiler repair or like commercial, cleaning, or someone that's got a very unique product that like needs doesn't want to sell their equity, wants to work with Heal Capital to get to the next level. They're not usually the Amazons, right? So then it's like to believe that that unicorn is the status standard for all is the wrong way of thinking about it, which hit the merchant account, get the money because I can just get there next. So we have to be more realistic with like, when are you going to make the money?
Well, by definition, the only thing that ever hits media headlines are the outliers, because that's what's like news. That's what's interesting because it's something different. So what's hitting the news headlines? It's somebody that raises a ton of money or gets a big valuation or goes bankrupt. But for the vast majority, 99.99% of companies, it's the companies that you described. They're in there day in and day out grinding it out. They're dealing with valuations that are, a couple $1 million. They're dealing with a few $100,000 of, profits or losses and all that type of stuff. That's the bread and butter of the economy.
And which back to what we were saying is I think it's beneficial and as because I want to compare and contrast what should be talked about and what should be ignored. Because I think back to like when you were talking about Huberman and Attia, for me, like I don't want to know how the mitochondria works, honestly. Like I've chosen because my passion is business to be this passionate about this topic, but like I'm so sick and tired of getting screwed. Like my wife's back is terrible, Patrick, and like I want I my anger is hard to withhold because of how bad it is, and all I want is to trust someone so they can take this away, and I don't know who to trust, and like so I think it's a little bit of like explain all the jargon so that way we can forget it. The moment we can find someone we trust, then it's like don't need to worry about that. It's like my buddy Jimmy Fritz, who was on the podcast. I'm like, hey, did you listen to that podcast? He's like, no, Ryan, I don't have to worry about that shit anymore. I just call you. I'm just like, so I'd say it's a little bit of like learn a little bit to forget.
Yeah, I completely agree, and I think that that's what entrepreneurs do, and they do it fairly well. But they pick up a couple nuggets here and move on. They shouldn't have to learn all the details. And just like what you've done is you're going to learn just enough so you can do the thing that you need to do in your life to live healthier, whatever it is you're trying to accomplish. And the same thing with entrepreneurs learning about accounting, finance. They just need to know enough so that they can make sure that they've got a good chance of netting ahead at the end of their journey and to make the whole journey worth it to them and their family is how I
Which is
think
that
about
time. Well, yeah, well, we're 100% aligned, and that the worth it is what you and I started the show with, which is the time. But like, and I think like when you think about all of the stuff that we've talked about, they're time extractors. So because by like whether it's that's really what it is, right? Because you take the wrong merchant funding, or you go with the wrong commercial bank, you go with the wrong service provider, you're slightly ahead or worse off in 12 to 18 months. And that's not what you wanted. You wanted more time, which you needed more cash flow to have more time. And when I think about so kind of bifurcating this into like the jargon to not jargon, which is like in order to forget all of this stuff while we run the company, it's free cash flow after working capital, taxes, and debt. Because like my whole spiel, Patrick, for people is like, hey, if you want to make 250 to 400 grand in free cash flow without the W-2, we need to see the path where you can afford the CEO. I mean, it's just like, because we need to see the path so you can make your income, because you can't stop making your income. But it's like, when can you make your income while someone else has got the W-2, but you need to have that expense in there, right? So there's like this hurdle rate that we need to be able to see how they can get on top of, like extract themselves from the expense and get the income from the cash flow. That's it, right? Like all the other jargon doesn't matter. And as long as we can see the visibility. But what I'm trying to do, Patrick, for other people, when I talk about the normalized EBITDA and the multiples and all this shit, is everyone's getting inundated with letters, phone calls, from people saying, I'm going to buy your company for $25 million. I'm like, they haven't seen your business. And it's going to be $1 million up front, an earn out, rolled equity. And so like, it's like trying to help people say, don't even pay attention to this shit. But then I sound like the crazy one. They're like, oh, Ryan, well, my friend got $25 million. And I'm like, so any thoughts about like kind of in your space too, like what the real world is? And then like, I still think we need to understand the normalized EBITDA and the multiples, because if they go to sell, it's like, how much do you need net?
That's all that matters, is what cash do they net after taxes, fees, and blarney.
And like back to Hill Capital and what you guys are doing with the capital matching. Like, if someone were to be thinking about, let me know if I've got this right, about contextualizing Hill Capital. It's like, okay, someone is trying to get on top of that, like get over that hump, and line of credit might not be the right approach for them. And a straight line, loan doesn't necessarily make sense, because there are situations like I might need to hire the executive team to get on top of it, top of that cash flow. Like I can
lend them money to hire people.
What's that?
Which a bank won't lend them money to hire people.
So maybe kind of contextualize Hill Capital then, because like I think there's some unique, what you guys are doing, what we're doing. It's like, hey, how do we get on top of this cash flow for the return? I mean, you're looking at the return of the projects, right?
Well, I would even take it back to what we've been talking about is building value. So the calculus always for an entrepreneur is, what do they want at the end of the day net? And what do they want that to look like? And then it's a calculation of how best do they get there? They could go slow and steady and utilize internal cash flows, again, if they're profitable, but utilize those cash flows to build up. They could utilize some bank debt, which typically costs 8 to 12%, depending on the market or whatever the case may be, and they can chip away. But when they bring in that money, then it's got to earn a return well above and beyond that. And then they can use other capital. And then on the extreme side, you can utilize equity, which if one's really doing the cost of equity, it's 50 to 100% for these early stage private companies. That's the real cost. Because if I put in $1 into a private illiquid company, I need a chance to get $10 to $100 back. And so one can compute what that would look like in terms of an annualized rate of return. And so that is the calculus that an entrepreneur needs to really think about, is like, okay, if I bring in equity or if I bring in debt, and what is the cost of the debt and all that type of stuff, how is this business going to grow? So I've got a better shot of getting the number that I ultimately need versus if I had just bootstrapped this and went slow and steady. And I think that's where the thing that I think is really sad is I've seen a lot of entrepreneurs. I know way more entrepreneurs what I'm about to say than I do that have actually rung the bell, but entrepreneurs that have taken in equity and taken in these types of capital sources, and then they netted way below where they wanted to be, if not just shut the business down because it didn't meet those high growth expectations that their venture investors and others needed to see out of the equation. Because for them, a few $1 million business was actually a massive failure because it never got to a 50 or $100 million. And so that's what I really encourage entrepreneurs is to think about, is like, what are they working towards? Now, as part of that, we've been working under the assumption that there's actually an exit event. And that's why I love your work, is because Independence by Design is thinking through, like, how could you actually build a business where you can stand back and be the owner and get enough cash flow so you net ahead back. And that's extremely valid. And that's a really wonderful way to think about it, because there are a lot of businesses that might want to hand it over to the next generation, make it multi-generational, or bring in employees as an owner, or just turn it into a full-on ESOP as well. And those are all very valid, but all of that requires some thoughtful thinking on the front end to what is it that one is looking to achieve, and what kind of capital do they need on the front end, and who are the right partners to help them get there. Because if I wanted to turn my business into an ESOP and I sold it to angel and venture capital in the startup days, well, I'm kind of screwed, because I don't ever have the option to turn it into an ESOP, because I have to sell the business for cash to give them a return. Now, there are some exclusions. Technically, one could buy them out, but that next to never happens. But
and because the VC's expectations is not, it needs to be a grand slam in order to actually hit the goals of that original investment, most likely.
A grand slam or a write-off, because they need to return money to their LPs in 10 years. Well, they need a tax write-off, right? And they need to show zero for a tax return. That's some of
Yep.
the little nuances behind the background that
Yep.
entrepreneurs never think about and understand. That's why they're
Yep.
driven to either like, sell for next to nothing or just wind down and shut down so somebody can take a loss on their on
Yep.
their on their
Okay. One on
financial.
yep.
And so those are really important parts. So then coming back to your question, how do we play in that? So as Hill Capital, we put in $1, we look to get $2 to $3 back. So that's where when we're talking to entrepreneurs in simple terms like that in the front end is if they're going to bring in $1, they need to be thinking about how does the business generate at least $5 and ideally for them $10 to $20 worth of long-term value because they brought in that external capital. If that meets that kind of like that threshold,
Mm-hmm.
that simple, easy litmus test, then it's like that could be a very good relationship with us. Because what we've done at Hill Capital is we think about equity. We have as much of an equity hat as we possibly can, but technically we structured as a note so we can get paid back over time. Because that is the key. Because if we
And
held
you got flexibility with that note too. It's not just like a bank loan, right?
exactly right. There's a lot of unique bells and whistles, and that's the problem with debt is people people think of debt as having personal guarantees, straight line, all sorts of stuff that is required as part of that debt. And so there's some very unique things that we do. We're utilizing that note structure, that debt structure, simply so we have a mechanism to get paid back over time. And one of our core values is transparency. It's all 100% transparent. People understand exactly what it looks like in our financial model. It's all calculated to the penny throughout the whole life. They understand how these things work. So then they can say and make the decision, does this investment make sense? And we collectively, Hill Capital and the entrepreneur, the business owner, has to say, yes, this makes sense. And then we move forward. Because if it doesn't make sense for either party, then forget about it.
Right. And you're matching the return that you need at Hill Capital for your investors with the economic engine of the entrepreneur's cash flow attributes to say, okay, because instead of sitting there with a gun to their head saying, we need 50K a month or whatever the loan payment is, it's like, hey, you did this for investments, but like you're constantly looking at the future and the present, juggling that with your ability, and the bells and whistles are your ways of getting returns on top of the flexibility and
Yeah, because we're very flexible
collaboration.
on, at the end of the day, we're very flexible on how we can get paid back. Whereas a traditional lender or a debt provider, they're just saying, I'm going to lend you, $1 and you're going to pay me 5 cents back for the next 60 months and da da da. And that just is what it is. And by the way, if you don't and you miss a payment, you're in default. And if you miss another payment, I'm going to call the loan due and lay in penalties and I'm going to put you under. Like, so there's all these
Your incentives are aligned with them of generating future cash flow.
exactly. Whereas we're
Yep.
all what we're interested in is that business creating value long
Yep.
term.
And as we're probably rounding the plate to home here is like, Patrick, one of the things I thought you said was really important. And I think it's important for, I don't know how to see it any other way, actually. And I'm curious on your thoughts on how I'm thinking about this. Like, so you're talking about the entrepreneur and like, yeah, like their goals of like the bigger picture, like what is different about my independence by design as this new iteration and kind of the final iteration of the ownership framework is extracting yourself and thinking like from the operations and thinking like this. It just allows you to do whatever the hell you want. But what has to happen, and the way I've articulated this to all my clients is like, in order to make any decision, like every day, what you and I do is we wake up and we make decisions. How to use our time and our money. We're just placing bets all day long. And like, how are we making those decisions impacts our ability to get towards our goals. And like the only way I've seen that this could work in the most appropriate and efficient way is like, okay, if we say, okay, today's 2025 and then 23, we have to pick a timeline, right? Because like financials are pegged to a timeline. You don't have to sell. I don't give a shit what you do, but like we have to say in this date, it could be 12 months, it could be 36 months or 60 months. This is what we think is going to happen with the income statement, the balance sheet, and the cash flow statement. It's like, okay, well, there's no money in the middle of that 60 months. Okay. What are you going to do about it? And it's like, okay, and then you're like, but now you've got visibility to say line of credit, cash flow from operations, put more money in, get money from Hill Capital. And it's like, well, the thing we even need to do before that is say, hey, owner operator, how much cash flow do you need in distributions? Because that's the constraint. It's like, hey, if you need 250, admit it and make that in like what I'm like in. And it's so fascinating hearing commercial bankers and like, I mean, it's literally how much shit do you have? Can we get your personal guarantees? Because like I have a couple clients, it's like like with the stop process, Patrick. I'm like, if you as the owner can mandate from your operations that you're making 40 grand a month in free cash flow, and it's as important as debt, you could technically flip that distribution into a seller's note or bank financing or anything, and just that's the intrinsic value of your company. And then and I'm just saying because what happens is so many people don't make themselves a priority. So it's like, well, if today versus 60 months from now, this is how much you need from cash flow, and this is the role I want along those that time span. And then at the end of that, what are my options that I want? But and I think about if someone says I want to go faster, I say, well, line of credit, conventional loan, talk to Hill Capital, but it should be so freaking obvious what they should explore.
Yeah. Well, how I've come to think about this is much more important than the model and what's in the model is everything you just described. It forces a process to think through all of these things. And that's where the value lies. And that's when in our underwriting process, when we put together these financial models, I know the numbers aren't going to be right. My team does, the entrepreneur, we talk about this. Like the numbers are only so good. It's a starting point in how to think about it, but it's forcing us to think about it. And going back to, it's forcing us to learn about the economic engine. Where's there a leak in the engine, or is there something over here, or da 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 da? And so can we optimize this and make it better over time? But that's where financial modeling and really good forecasting is extremely valuable exercise, because it's forcing to think through all of those things. And I love to give thinking about this, I love to give the analogy. I talk about this in the book is Dell Computer. I mean, Dell Computer was the first really well-known documented case of a company that had a negative cash conversion cycle, meaning that they were getting paid ahead. They were netting cash ahead of putting any money out, because they were early adopters to sell computers online, taking a down payment, or if not the full payment, then buying the parts and then assembling the computer and shipping it out. And so it sounds obvious today, but that was extremely innovative 20 years ago. And so that's an example of like economic engine. And that's where we see a lot of our portfolio companies, see a lot of companies where they're doing the thing. They're running their business and stuff like that. But there is a lot of economics available to them if they really think about how to optimize that.
Mm-hmm.
You talk a lot about it on your podcast and your work, and some of it is simple and straightforward as, if you have receivables, collect them faster.
I just walked. I walked through with a client yesterday. It was like we went through his receivables and we looked at the normalized working capital. I'm like, there's your $1.5 million right there,
locked into your business.
Yeah. How did you start? It was like, there's money that you owe. There's other people have your money. You have some people's money. How did you word it?
Well, I call it the cash management trifecta. And so there's three pieces to it. It's the cash balance, what others owe you, and what you owe others. So it's really simple. Your current cash and what others owe you has to be greater than what you owe others. and literally, that's where I've taught, and I encourage entrepreneurs to literally keep it that simple.
By the way, get 8 hours of sleep, wake up, move your body, eat some good food.
Just look at how much cash you have. I mean, that is ironic. Like we started the conversation, but I've got tens and tens of thousands of hours on this type of stuff. My whole career is this type of stuff, and ironically, I've come full circle to just that equation. It's that simple, and that's why. We talk about free cash flow and there's other terms that one can think about cash flow. But at the end of the day, it's like, are you actually netting cash ahead at the end of every month or quarter or annually or whatever?
And if you're not, can you see when you will?
Yeah. And you can get cutesy on, the accounting terminology or whatever. But, if you bought a tractor along the way, well, that's CapEx and that was cash out, so it's like very obvious to the entrepreneur, but keep it that simple, because that's what matters. You may have a nice business farming, but if all of a sudden you're buying $1 million tractor every year, and your income from farming was $200,000, you're actually losing $800,000. And somebody can get really cute and talk to you about like the advantages of taxes to like buy this stuff so you can write it off and stuff like that. But at the end of the day, you're out that cash. At the end of the day, that's what matters. So
Oh,
that's
it's
why
like,
I actually like paying taxes. And that's why I've come to really dislike that whole term EBITDA, because depreciation and amortization is a very real number. And except for a few companies, very large companies, it's a very real number for small businesses. So the whole idea that we're trying to back in non-cash things or whatever, that DNA, that non-cash stuff was actually caused by a cash event. And that's why I think it's very mischievous of Wall Street and others to like convince people that EBITDA is some poster child
oh,
of a
and
solution.
yeah. And so, you got to like 10 more minutes because I want to land this plane because I think that this is an insanely important topic because, um, agreed with you wholeheartedly, Patrick, and I want to explain why. And I think like, but it's also it's because like I think it's important to understand why. So like, okay, so when I think about this, and like when I said with GPT and all the transcriptions and I mean, like the hundreds and hundreds of books I've read to land exactly where you are, and it's like, well, why do I know this? Because when I look at a cash flow statement and like a future cash flow statement, it's like, okay, everything has to go through the income statement, on track, off track, has to roll through the balance sheet that's accurate, and then we get to net income on the cash flow statement. We go through working capital, so payables, receivables, inventory, and all that stuff. And then we get down and say, okay, cash provided by operating activities. Okay. So like it could be higher than net income. But then it's like, okay, how much is that? Cash. And then what the hell do we do with it? Well, then it's like CapEx. So if you're gonna buy some shit, you're gonna the cash will be smaller. And then it's like, okay, well, I got taxes. So I gotta take the taxes out of there. And then it's like, well, I need 20 grand as the owner. And then it's like, how much is left over? It's
Yeah.
like, and that like, it's
Well,
like
and
this
you also
plinko.
need
And
to
it,
take in the financing because interest comes through, but you also have to
yep.
consider principal repayments and the things that aren't hitting
That's
the.
what I meant. Yeah. And debt. Sorry.
So,
Yeah. And the debt and the interest, but
yeah,
like it's those, those right there. So like, it's so, Patrick, you would literally have laughed your ass off. I was in a Vistage workshop and it just so happened to be in California. And I think it makes sense, the response I got, because I was teaching this part of the cash flow statement and I got to cash after all of the debt, taxes, working capital, and the capex, reinvestment, distributions. And I said, and this $450,000 is cash. And the guy goes, you mean like real cash?
yeah, exactly.
I was like, no, NFTs, dude. Like, no, like actual like money, because those are the constraints. And then what I do with people, Patrick, is I say, okay, if this is zero, here's the decision tree. Tap your line of credit. Can't, it's tapped. Okay, kick the tax can down the road. I can't. Well, you got to pay your debt payments. And it's like, well, maybe you can't take your distribution. Well, I need to, guys. I got boats, cars, cabins, and like, it's like, okay, well then raise some equity. Well, I don't want to sell it. It's like, well, I'm not Jay Powell. I can't print money on nothing. So you like, I'm not God. You have to do something. Like, and it's acknowledging those constraints. That it's just like back to like all of the jargon and bullshit aside. That's where the decision tree happens, really. But at the same time, I think everybody listening in here knows that, whether they, these terms kind of float around because there's still some technical terms that, people that aren't truly in the numbers all the time, but like they understand that because they're dealing with the operations every day. But then they get these letters, they listen to Alex Ramosi or Cody Sanchez or you name the freaking thought leader that's saying, buy a company, zero money down, or you can pay 7 times normalized EBITDA. And I sit there and go, I've got clients that are doing $1 million in normalized EBITDA, but the free cash flow allowed for debt service is 40K a month. And then if you did a straight line math, and you're like, okay, well, that's literally 450, 500 grand that could actually service debt without suffocating growth and taxes and everything else. So like the thing mathematically can't be worth $5 million because it can't service like it's 70 grand a month in debt service on a 10-year SBA loan. So you sit there and go but like understanding like the normalized EBITDA is important to forget or not be distracted by what the hell people are saying out there.
Yeah. But again, that it would only be worth so much to a buyer if they themselves had to take on debt to make that purchase. If somebody's going to buy that business that doesn't have to rely on debt and those cash flows, then valuation changes a bit, and that's where people can get breakout valuations. A little
Agreed.
side note there, but the vast majority of businesses are Main Street type of businesses and so forth, and the buyer has to utilize SBA and leverage on the back end to buy it. But if somebody's just paying for cash, that's where there can be premiums paid.
Well,
And
and I know I think
that's where the discounted cash flow models and all that type of stuff, it's a great exercise. It's the tools of the trade of the valuation experts and all that type of stuff. But that's where you've had podcast guests that have talked about storytelling as part of the process. Absolutely necessary. And that's why my next body of work is all about magnetic vision. But that entrepreneur has to be able to tell a vision of where that business is going, because that's one of the real drivers of value for all businesses. And
because
some
you're teaching that you're preaching the future possibilities. But and this is actually, I think what you said is actually we're in sync here, because here's kind of like, it's almost like a layered thought process, Patrick. In Because like the way I think about it, because like I mean, even over the years that I've known you, you're even so much more relaxed and like confident, relaxed of like, this is just how the world works, right? And it's just like, and like, and I like want that level of relaxation for the people listening in, so they don't have to have this anxiety of all this jargon and bullshit. But it's like, okay, there's a layered thinking. It's like, okay, well, if I have no plans on selling right now, it's like, well, like creating that distribution, that free cash flow distribution should be kind of priority number one. But then it's like the moment I start thinking about the magnetic vision, to use your term, like the future possibility, if they want to sell to a third party, it's kind of like then the exit options get layered on top of this. It's like, okay, now I'm sitting on top of the capital and I'm going, okay, ESOP is one type of like legacy valuation deal structure. And I did a whole podcast on deal structures recently too, Patrick. And then it's like, well, if someone's going to try and get max value, a breakout valuation, finding that buyer who can monetize that asset and that vision that you've pitched, and you're connecting the possibilities, your economic engine with theirs, it has no, it actually, and I'm saying this, I'm curious if you would use these words, but I've actually said to people, the cash flow valuation is completely decoupled from the sale price. Like it's all about what you could teach or preach as the vision of what the possibilities of future value could be.
Yeah, because it plants the seed, but the value is in the hands of the new owner.
Mm-hmm.
So a
Mm-hmm.
great example is if a business is regionally focused and sells to a national player, and they can take that product and all of a sudden, quadruple, distribution overnight,
Mm-hmm.
there's a lot of value. And that value can be captured by the entrepreneur.
Yep.
And
Yep.
that's what's really important for entrepreneurs to understand and to be empowered by that. Because if they don't go through the process of having a forecast, having a vision, thinking about what, their product or service could be in the marketplace, they're going to get snookered out of a heck of a lot of money. They're going to leave a
Mm-hmm. Mm-hmm.
lot of money on the table. And that's
Mm-hmm.
what happens a lot. Because
And
everybody
or not even have the options that they might have otherwise, right? Because it's like the way I think about it, it's optionality, right? Because it's like,
Exactly, which is worth a lot by itself, because then an
right.
entrepreneur, that's what we talk about all the time with Hill Capital too, but we want the entrepreneurs to have that option. Because I've seen it, Ryan, where and I hear this all the time, where business owners, they want to sell their business, but they also want to make sure that the culture and the employees are taken care of. And they will give up money, they will give up some premium on the exit to make sure that their legacy or their culture is taken care of along the way. So there's value to that. But one has to really think about that, because you, like with your work and so forth, one might come to the conclusion, and I would highly recommend it, that they say, well, geez, actually, if I set this up correctly and listen to Ryan's work, I could net what I need on an annual basis, cash out, and achieve my objectives than if I had just sold to a third party buyer who's guaranteed that's going to probably screw up the culture in some way, shape, or form, anyways.
Well, and I think there's there's even a myriad of issue or of a myriad of options in between there, Patrick, which and I literally do not care what anybody does, Patrick. Like all that all I do and the way my brain works is like holding people's hypocrisy in front of them, saying, okay, well, like you said both of these things, and both of these things can't be true because we have these constraints. I'm just like, here are the constraints, here's what you said, these don't reconcile. I don't care what you do, but like we have to level set the expectations. And I think then with stacking on the layers of thought process, saying, okay, hypothetically, let's say you say, okay, Ryan, I don't want to do my job anymore. I'm willing to work 20 hours a week, but like I want someone else to take it over, but I need my 20 grand a month. It's like, okay, well, that's step number one. All right, then like, okay, then you say, you know what? Now I can think about, the bigger picture. You either focus most of the strategy, the magnetic vision to then do what? Where's the next level of the company? This is what I mean, like working on the business, the capital allocation and vision that you're talking about. But then it's like, okay, well, if like we have to reconcile like culture plus the value, because like back to your point, it's like the cash flow valuation to like service a buyout on its own can only mathematically yield so much
Exactly right. That's
based
exactly
on their much.
yeah.
So just to bear with me for a second, because like on the deal structure podcast I did recently, I think I was trying to get this across where it's like, okay, so if you did like an SBA loan, you would get all the money up front, but there's only so much that can be financed. So it's like, well, then you say, well, I want the internal buyer, and this is exactly what I want. But it's like, hey, you only get 2 of the $5 million up front, and well, that's not enough. It's like, well, okay, I'm not God. What do you want me to do? Take more time to grow it, or like then we kind of go up the options and say, okay, well, in an ESOP, you could get half your money up front from a senior lender. The company no longer pays taxes afterwards. So you get half your money up front, you get the other half in mezz financing and warrants. And there's no and there's no taxes. So that frees up some cash to where you can probably refinance the company again in 5 years. So you're 5 years, you're getting all your money. But then you go one layer up to like a private equity firm. And then you could get, another bigger chunk of your money up front, but you're rolling equity and you don't control it. And then you're selling your company to a strategic where you want to get as much money up front. But what I've tried to I don't give a shit what people do, Patrick, but it's like, hey, if we think through how much money do you need at closing net? At closing, because the rolled equity, seller's notes, all this stuff, there's more risk tied to more constraints because you don't have complete control anymore. So I'm trying to help them say like, okay, well, my culture, it's like, how much is your culture worth to you, Patrick? How do you think about my thinking about how to like kind of layer in the nuance of like, how much do you need up front, cash flow and then equity? And then then you can start layering on your options on top of that.
Yeah. And I think what you and I really care about at the end of the day is to make sure entrepreneurs think through and understand that they do have options, because it's a really, really sad day when a decision was made and that they're forced to go do something when they could have had a much better outcome that would have worked better for them mentally, emotionally, for their family, for their checkbook, so on and so forth.
Yeah. Yeah. And you know what, Patrick? Amen to that, brother. And like when I realized that people don't have options is, and I'm seeing this right now a lot, man, is
Yeah.
people are like the moment energy dissipates because they're just like, if the whole thing, it could be a $10 million, $20 million, it's like, I have to wake up and eat shit every day and
Yeah.
I'm tired. And then it's like, well, by the way, you have to work another 36 months, do all these hard things. And people go, well, I called you because I'm tired. And it's just like, man, like I can't, I mean, there's people I'm working with. It's like, it's really hard to overcome that exhaustion once it kicks in.
Yeah. That's why hopefully they will listen to podcasts like this earlier.
If people are still listening, I'm like,
if people like catch some of these nuggets ahead of time. And again, that's why, I love peer groups, whatever shape or form they take, but hopefully they can pick up nuggets from other entrepreneurs and executives and so forth, and hear your work and so forth, and pick up these nuggets. Because that's what's important, is that they start thinking about these things before it's too late, or make a decision and set something in motion that they didn't fully intend.
That's why I recommend picking up your book, Breakout Valuation. I'll put links to Hill Capital. Any other links you want me to put in the show notes?
No, but I would encourage people to think about things like the Entrepreneurs Rally and other events that people get together, it's extremely valuable. So whether you're part of a peer group or not, there are events like the Entrepreneurs Rally. So that's always in May of every year. This coming year, we have Damon John coming in to speak, and
Oh,
we've had
cool.
Rodriguez and others speak in the past. And so, but it's all about those connections to having 30, 50 quality conversations at the roundtables throughout the day. So again, happy to be a connector because that's the one thing, that's the only thing I've ever seen move the needle for entrepreneurs is when they have quality conversations with their peers.
Are you guys still doing the Empire Builder here in the Twin Cities? I know I'm on the emails too. So for people that are in Minnesota listening in, you guys
Yes.
have quite a few events that also provide a lot of good
Yeah,
context.
the Hill Capital Summit is every late fall. So our
Okay.
upcoming event is in November. So we rebranded it the Hill Capital Summit, and that is in the Twin Cities. We have a lot of people that come in for that event, and long term we'll host it outside of the Twin Cities. But for now, we keep it simple in our backyard.
Thanks so much for the time, Patrick. It's so much fun, man. I appreciate it.
Yeah, likewise, Ryan. It's a lot of fun to connect.
Thanks for tuning in for the conversation with Patrick. I hope you had as much fun listening as I had doing the interview. I thought there was a couple important takeaways to note. Understanding this stuff is daunting sometimes. And yes, as Patrick and I started the conversation, it's a lot of jargon that is irrelevant besides the trifecta of free cash flow. However, for me, I just have found it unbelievably empowering to learn all this stuff so that way I can ignore it when it doesn't matter and I can focus on the things that matter most. Because as you've heard me talk about in the recent episodes, time is our most valuable resource. And if we don't know what we should be spending our time on because we get confused by all these terms, then it becomes a distraction and we actually are eroding our potential. But if we understand when and how these different terms are used, we can focus on running our business. And when it's time to make a decision on a transaction or get funding, we know when and how and why that conversation matters and what the goal is that of the person that's sitting across the table and how that matches up with our goals. So I think that the education is paramount in order to actually focus on the things that matter most, like Patrick talked about, which is cash flow. Next week, I'm going to have Bill Mills back on the show. He was on the show, I think it was a couple months ago, talking about his leadership team process, talking about how to actually extract culture from you and put it into the organization and get the efficiencies and the execution from your executive team that you think is potentially possible. And he brings on his case study, Heather, who ran a business and implemented Bill's program, and she has completely destroyed and crushed all of her goals. When I mean destroyed, I mean crushed. And they're going to be sharing how Heather implemented a lot of the stuff that we're talking about on the show and what Bill's leadership process did for her ability to almost 5x the company, get into mergers and acquisitions, and create ridiculous shareholder value for the ESOP. So you're going to have to make sure you tune in for next week. Thanks everybody for tuning in, and I will see you next week.